Investing can feel confusing at first, especially if you're not sure where to begin. In this guide, we'll walk through how beginners in the UK can start investing confidently, safely, and with a long-term mindset. If you've ever felt like your money doesn't stretch as far as it used to, you're not imagining things. That's inflation at work. Leaving your savings sitting in a cash account might feel safe, but over the long term, inflation quietly reduces its purchasing power. Think of it this way: the $100 you have tucked away today might only buy you $95 worth of goods in a year or two. Over decades, this effect can significantly erode the value of your hard-earned cash, making it harder to reach your financial goals. This is where investing comes in. Instead of letting your money lose value, investing gives it the potential to grow. It allows your money to work for you by participating in the growth of companies and markets across the UK and the world. When you invest, you're essentially buying a tiny piece of a business or a collection of assets. As these businesses succeed and the economy expands, the value of your investment can increase, helping your wealth outpace inflation. Now, this isn't about get-rich-quick schemes. For beginners, the goal isn't chasing fast, risky profits. It's about building a solid foundation for your future through steady, long-term growth. It's a marathon, not a sprint. At its core, investing means buying assets that can grow in value over time. Think of an asset as anything you own that has the potential to make you money. The fundamental goal is for your money to work for you, generating returns that can help you build wealth and outpace inflation. However, it's crucial to understand the relationship between risk and reward. Generally, assets with the potential for higher returns also come with a higher level of risk, meaning their value can fall as well as rise. Finding the right balance for your personal situation is key. For most beginners in the UK, two of the most common starting points are stocks and ETFs. Let's start with stocks. A stock, also known as a share, represents a small piece of ownership in a single company. When you buy a share, you become a part owner, sharing in the company's potential profits and losses. Next, we have exchange-traded funds, or ETFs. Think of an ETF as a basket that holds a collection of many different investments, often hundreds or even thousands of stocks or bonds, all bundled together. When you buy a share of an ETF, you're instantly investing in all the companies it contains. This is why ETFs are often preferred by beginners. They provide instant diversification. Instead of putting all your eggs in one basket by buying a single stock, you're spreading your investment across many. This diversification helps to reduce risk, as the poor performance of a few companies can be balanced out by the positive performance of others, leading to a smoother investment journey. Many people believe investing requires large sums of money. In reality, many modern investing platforms allow you to start with small amounts using fractional shares. What matters more than the starting amount is consistency and patience. Once you understand the basics, the next step is choosing where to invest. In the UK, a growing number of platforms are designed specifically for beginners, making it easier than ever to get started. But with so many options, how do you pick the right one for you? It's crucial to look beyond the marketing and consider a few key factors. First and foremost is regulation. Ensure any platform you consider is authorized and regulated by the Financial Conduct Authority, or FCA. This provides a layer of protection, including access to the Financial Services Compensation Scheme, which can protect your money up to $85,000 if the platform fails. Next, look closely at the fees. While many platforms advertise commission-free trading, this doesn't mean they are entirely cost-free. Be aware of other potential charges, such as platform subscription fees, currency conversion fees for overseas stocks, or withdrawal charges. These small costs can add up over time. Usability is also key. A good platform should have a simple, intuitive interface that makes it easy to find investments, track your portfolio, and access educational resources. Some popular user-friendly options in the UK include platforms like Trading 212 and Free Trade. These platforms typically offer straightforward access to a good range of stocks, and importantly, the ETFs we discussed earlier. Taking the time to compare these factors and choose a regulated, well-known platform is a vital first step on your investment journey. Once your account is set up, focus on starting small, investing regularly, thinking long-term, avoiding emotional decisions. Investing is a process, not a race. Trusted investing platforms mentioned in this guide are linked in the description. Take your time, do your research, and invest at a pace that feels right for you.